Welcome to the Adkins Capital Management First Quarter 2026 U.S. Residential Housing Market Review. My name is Troy Morris Adkins, founder and chief executive officer of Adkins Capital Management. The mission of Adkins Capital Management is simple but critical: to bridge the gap in the residential housing market by providing prospective home buyers with the objective information and analytical tools that they need to make a truly prudent home purchase decision. This quarterly review covers the most important housing and economic developments that occurred during the first quarter of 2026, from Federal Reserve policy to regional price dynamics, all filtered through the lens of the Adkins 60 City Home Price Index. Let's get started. This presentation is organized into four core sections. First, we examine what I am calling the affordability economy, the historic market divergence unfolding across the United States in 2026, where Sunbelt cities are seeing significant price corrections, while Rust Belt and Midwest markets are surging on affordability-driven demand. Second, we review the monetary policy actions of the Federal Reserve during the first quarter of 2026, including the two decisions to hold interest rates steady and the forces that drove those decisions. Third, we present the Adkins 60 City Home Price Index analysis, identifying the 5 most overpriced and 5 most underpriced cities in the United States as of the end of the first quarter. And finally, we provide resources for prospective home buyers who want to take the next steps in their analysis. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 20 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, more than 8 years of freelance financial and investment writing experience, and more than 5 years of state government experience at the agency and legislative levels. I am also the author of more than 25 published financial and investment articles. Accordingly, I am a 2023 inductee into Marquis Who's Who. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. The executive summary for the first quarter of 2026 reflects that housing affordability is primarily a labor market and income distribution problem. The most important housing research development of Q1 2026 comes from an unlikely source, the Federal Reserve Bank of San Francisco. Published on February 2, 2026, the San Francisco Fed found that across 321 metropolitan statistical areas from 2000 to 2020, average income growth tracked house price growth essentially 1-for-1. In other words, cities got more expensive because high-income earners bid up prices, not because cities failed to build enough housing. The AEI Housing Center's Q1 2026 Housing Market Indicators Report, released in March, corroborates this with current data. Year-over-year home price appreciation fell to 1.1% in February of 2026, the lowest in the AEI series,
while FHA delinquencies rise and debt-to-income ratios reach historic highs. The NAHB Housing Market Index stayed below 50 in negative territory for the 21st consecutive month. 36 to 40% of builders cut prices. 60% or more used sales incentives for 13 consecutive months. The Urban Institute's February 2026 chart book shows the 30-year mortgage rate at 6.09% provided marginal affordability relief, partially offset by continued price appreciation. And FHFA's reduction of its own GSE low-income purchase benchmarks, effective February 23rd, signals a regulatory acknowledgement that affordable housing access is declining, not improving. The convergent message across all institutions: the affordability crisis is a labor market and income distribution problem. Zoning reform will not fix it. Let me walk through the San Francisco Fed's research in detail, because its implications for prospective homebuyers are profound. The researchers studied 321 metropolitan areas from 2000 to 2020. Their central finding: average income growth, not supply constraints, tracks house price growth 1-for-1 across metro areas. In metros like San Francisco and Los Angeles, where high-wage tech sector job growth concentrated income among a narrow group of highly skilled workers, prices soared. But housing supply grew only modestly because the specialized nature of those jobs limited the number of workers who could fill them, constraining population growth and, in turn, new unit demand. Houston and Austin, by contrast, had broader-based job growth, attracted more people, and saw both prices and supply rise together. Here's the key insight: 85% of U.S. metro areas saw housing supply grow faster than their population, even in expensive markets like Los Angeles and San Francisco. Cities are building. The problem is that high-income demand is bidding up prices faster than median incomes can follow. The San Francisco Fed concludes, and I quote, that regulatory reforms may have limited impact on housing affordability. This is a Federal Reserve institution directly telling policymakers that the zoning reform agenda, while potentially useful at the margins, will not solve the problem. The AEI Housing Center's own Q1 2026 data confirms the stress this creates at the borrower level. FHA delinquencies rising, DTI ratios at historic highs, builder price cuts every month. The housing expansion has run since 2013, and the affordability strain is now visible in credit performance. The builder data from Q1 2026 is striking in its consistency. Every single month of the first quarter, January, February, and March, the NAHB Housing Market Index came in below 50. Builder confidence in negative territory for the 21st consecutive month. This is not a temporary dip. It is a structural condition reflecting chronic affordability stress in the lower and mid-range market segments. 36 to 40% of builders cut prices every month in Q1. The average price reduction was 5 to 6%, and 60% or more used sales incentives, rate buydowns, lot premiums, upgrades for 13 consecutive months. That is not a market healing, that is a market straining. The AEI Housing Center flags something more troubling than sentiment. FHA delinquencies are actually rising. Debt-to-income ratios are historically elevated. When you have borrowers stretching to their limits on DTI, FHA allows up to 57%, and home price appreciation is simultaneously decelerating to 1.1%. The combination creates financial stress at the borrower level. Homes that were purchased at the margin of affordability are now holding owners in difficult financial positions. The AEI notes an irony in current policy. The taxpayer-backed competition between FHA and the GSEs in low and low-medium price tiers is actually putting upward pressure on prices in those tiers, making the affordable segment less affordable, not more. And the Urban Institute's February 2026 chart book confirms that despite a 6.09% mortgage rate and modest income growth, affordability gains remain marginal. The Credit Availability Index is near its tightest level since tracking began. The Q1 2026 policy actions by FHFA, AEI's analysis of the investor ban, and NAHB's remodeling data together paint a coherent picture of where housing policy is heading and where it is failing. FHFA's decision to lower its 2026 to 2028 low-income purchase benchmarks for Fannie Mae and Freddie Mac, effective February 23rd, is quietly significant. It means the government's own housing finance regulator has concluded that pushing the GSEs to originate more mortgages in low-income tiers is no longer feasible given market conditions. The market level for low-income purchase mortgages is declining. FHFA is adjusting its goals to reality rather than aspirations. AEI's April 2026 analysis of the Senate's proposed institutional investor ban is equally sobering. The policy would restrict large investors from buying single-family homes, a politically popular move. But AEI finds that institutional investors represent only 1 to 3% of the for-sale market, while their build-to-rent communities have added over 170,000 homes to housing supply. Restricting them removes supply without reducing purchase prices for anyone. Meanwhile, the one genuinely positive data point in Q1 2026 builder sentiment, the remodeling market, the NAHB Remodeling Market Index held at 62, firmly in positive territory. NAHB Chief Economist Robert Diaz explained this directly. It reflects an aging housing stock and a lock-in effect keeping owners in their homes. Owners who cannot afford to sell are investing in improving what they have. The bottom line for every prospective home buyer in this audience, the institutional consensus in Q1 2026 from the Federal Reserve, AEI, NAHB, Urban Institute, FHFA, Fannie Mae, and BlackRock is that the affordability crisis is structural and will not be resolved by near-term policy. The Adkins 60 City Home Price Index gives you the analytical tool to navigate this environment with clear eyes. We now turn to the monetary policy actions of the Federal Reserve during the first quarter of 2026. This section is critically important for prospective homebuyers because Federal Reserve policy directly influences the cost of mortgage financing and therefore the affordability of every home in the Adkins 60 City Index. The headline for the first quarter of 2026, the Federal Reserve held interest rates steady amid persistent inflation and mounting economic uncertainty to employment and a weakening labor market. The reasons for the pause are important to understand, and we will cover them in detail on the next slide. In the first quarter of 2026, the Federal Reserve held interest rates steady at both its January 27th through 28th and March 17th through 18th meetings. maintaining the federal funds rate target range at 3.5 to 3.75%. The economic backdrop was one of resilience mixed with stubborn inflation. GDP growth remained solid entering 2026. The labor market, while showing signs of moderation, held firm. But inflation remained above the Fed's 2% target, and some FOMC participants noted that further progress in reducing inflation had stalled in recent months. A significant new development emerged mid-quarter. A conflict in the Middle East caused a sharp spike in global energy prices, raising both inflation concerns and economic uncertainty. The post-meeting statement from March explicitly noted that the conflict was contributing to a high level of uncertainty about the economic outlook. The January hold saw two governors dissent in favor of a quarter-point cut. The March decision was unanimous, though subsequent minutes revealed that some officials had begun favoring a two-sided policy framework, one that would leave open the possibility of rate hikes if inflation persisted above target. For mortgage borrowers, the impact was direct. The national average 30-year fixed rate began the quarter at approximately 6.15%, the rate which it ended 2025, and ended the first quarter of 2026 at approximately 6.38%, as rising energy costs and inflation expectations pushed Treasury yields higher. The all-time low for 30-year mortgage rates remains 2.67%, set on December 17th of 2020. The all-time high was 18.63% in October of 1981. We now turn to the Adkins 60-City Home Price Index analysis, the proprietary valuation methodology at the core of everything Adkins Capital Management does. This section answers a question that every prospective home buyer should be asking. Is the home I am considering buying priced fairly, given my income, today's interest rates, and the fundamental relationship between household earnings and housing costs? The Adkins methodology was developed specifically to answer that question with institutional-grade analytical rigor. The same kind of rigorous, data-driven analysis that sophisticated investment managers use to evaluate assets, applied to the most important financial decision most individuals will ever make. The Adkins Residential Home Valuation Analyzer is built on a straightforward but powerful financial principle. The justified home price is a function of three variables. The first is household income level, specifically the median household income for the city being analyzed. The second is the percentage of that household income that should reasonably be allocated to repaying the principal and interest costs of a mortgage loan. Adkins Capital Management uses 28% as the benchmark, which aligns with the traditional mortgage underwriting standard that has guided prudent home lending for decades. The third is the cost of debt, specifically the current national average interest rate for a 30-year, fully amortized, fixed-rate mortgage loan. From these three inputs, the analyzer calculates two key outputs: the justified mortgage loan interest rate, which is the rate at which a given home price would be justified for a given income level, and the justified percentage of household income, which is the actual percentage of pre-tax income a buyer at that income level would have to spend at the current mortgage rate to buy the home in question. When those outputs diverge dramatically from the 28% benchmark, the market is sending a clear signal: the home is overpriced. The Adkins 60-City Home Price Index tracks housing valuations across 60 cities, representing a broad cross-section of the United States, from the nation's largest and most expensive metro areas to mid-sized and smaller markets. The headline finding for the first quarter of 2026 is stark. 56 out of 60 cities in the index are flagged as overpriced based on the justified percentage of household income analysis. That is 93% of the cities we track. This finding reflects the ongoing reality that despite some regional price corrections, the structural affordability deficit in American housing remains profound. The next several slides present the 5 most overpriced cities and the 5 most underpriced cities in the index for the first quarter of 2026. The 5 most overpriced cities in the Adkins 60 City Home Price Index for the first quarter of 2026 are New York City, San Francisco, Los Angeles, Newark, and Miami. What makes these cities so dramatically overpriced is that no reduction in the mortgage interest rate, not even to 0%, can justify the home price level relative to median household income. These markets are structurally, fundamentally unaffordable for the median household. At the current first quarter 2026 mortgage rate of 6.38%, New York City residents would need to spend 67% of pre-tax household income to repay the mortgage on a median priced home, more than double the 28% prudent benchmark. San Francisco requires 59%, Los Angeles 58%, Newark 64%, and Miami 58%. To justify these home prices at the 28% benchmark, the median household income in New York City would need to be approximately $191,000, more than double the actual median of $79,713. Let me put those numbers in even sharper perspective. For New York City, the median household earns $79,713. The median home costs $895,000. To afford that home at the 28% benchmark at today's mortgage rate, you would need a household income of $191,539, 2.5 times what the median household actually earns. The justified home price, given what the median household actually earns, is $372,473, less than half the actual price. For San Francisco, the median household income of $141,400 is already among the highest in the nation, and yet it still falls dramatically short of the $297,474 needed to justify a median home price of $1,390,000. The message to every prospective home buyer in these markets is clear. Use the Adkins Residential Home Valuation Analyzer to rigorously assess the level of overpricing in your specific market and your specific situation before making a decision. In contrast to the dramatically overpriced coastal and Sunbelt cities, the Adkins 60 City Home Price Index also identifies 5 cities where homes are genuinely underpriced relative to household income and today's interest rates. Those 5 cities for the first quarter of 2026 are Detroit, Michigan, Fargo, North Dakota, Jackson, Mississippi, Wichita, Kansas, and Huntington, West Virginia. In these markets, the math works in the buyer's favor. In Detroit, a median household income of $38,100 is sufficient to justify a median home price of $90,000. The justified mortgage rate is 14.63%, meaning that even if mortgage rates rose dramatically from their current 6.38%, these homes would still be affordable at the 28% benchmark. Fargo, Wichita, Jackson, and Huntington tell similar stories. These are markets where the fundamental relationship between household income and home prices is intact, where the ACM methodology signals a genuine opportunity for prudent home buyers. It is worth noting that these are precisely the kinds of Rust Belt and Midwest markets that are now seeing strong price appreciation, as the national affordability story redirects buyer demand toward markets where homes are actually affordable. For prospective homebuyers who want to go deeper in their analysis, Adkins Capital Management offers a comprehensive suite of research and tools and resources. Visit our website at residentialrealestateanalysis.com to access the complete Adkins 60 City Home Price Index, our interactive city-by-city housing analysis map, our news feed of pertinent housing market information, our housing methodology patent application, our reverse mortgage loan analysis, our full movie catalog of quarterly residential housing market reviews, our housing valuation methodology presentations, and our tactical and strategic residential real estate hedge fund model portfolio. You can also visit Amazon.com to subscribe to the Adkins Residential Home Valuation Analyzer. Simply search for residential real estate software. A 15-minute movie presentation providing a complete overview of the analyzer is also available. These tools are designed to give individual home buyers the same analytical depth and rigor that institutional investors bring to their real estate decisions, because the most important financial decision of your life deserves institutional-grade analysis. Thank you for watching the Adkins Capital Management First Quarter 2026 U.S. Residential Housing Market Review. The key takeaways from this quarter: the U.S. housing market is in historic divergence, a two-speed market where Sun Belt corrections and Rust Belt surges are unfolding simultaneously. The Federal Reserve paused its rate-cutting cycle as inflation remains stubborn, and the Middle East energy shock added uncertainty. Mortgage rates ended the quarter higher than they began, and the Adkins 60 City Home Price Index confirms that 56 of 60 markets remain overpriced, with the most extreme overpricing concentrated in New York City, San Francisco, Los Angeles, Newark, and Miami. The bottom line for prospective homebuyers: do not make the most important financial decision of your life without doing the analysis. The tools exist. The data exists. Use them. This presentation was produced at the New York Public Library and Business Library at the 5th Avenue and Madison Avenue locations in the borough of Manhattan, New York City, New York. The contents of this presentation are the property of Adkins Capital Management. No part of this report may be reproduced, redistributed, displayed, or transmitted without the written consent of representatives of Adkins Capital Management.